Ever looked at the frenzied world of the stock market and felt utterly lost? It's not uncommon to hear people liken the stock market to a vast, unpredictable ocean, where fortunes seem to be made or lost based on whims, or perhaps, pure luck. Amid the flashing screens and rapidly changing numbers, the stock market, to the uninitiated, often appears as a realm of chaos. There's jargon that sounds like a foreign language, and graphs that look more like heartbeat monitors than indicators of financial health. But what if we told you that beneath this seemingly chaotic exterior lies a structured, methodical system? Think of the stock market not as a game of dice, but more like a vast puzzle waiting to be pieced together. While it might seem that seasoned investors have an uncanny ability to predict the future or a magic crystal ball tucked away somewhere, the reality is far from it. Instead, they have tools, methods, and systems that guide their decisions, and help them decode the complex tapestry of the financial market. Ever heard the saying, buy low, sell high? It's a phrase often tossed around when people talk about the stock market. To many, it might sound like simple, even vague advice. But how do you truly know when it's the right time to buy low? Is it all just a game of luck and gut feelings? The truth is, behind this catchy slogan, there's a sophisticated method that savvy investors use to navigate these decisions. Enter the DCF model, the hidden key that illuminates the best moments to buy in. Far from random, this approach is a calculated dive into the real worth of a stock, providing insights many overlook. Stick around, and we'll unravel the magic behind determining when to buy low using DCF, revealing that it's not about luck, it's about strategy. DCF stands for discounted cash flow. The ultimate goal of a DCF model is to calculate the intrinsic value of a stock, its true, inherent, and calculated value based on fundamental analysis rather than its current market price. By calculating the intrinsic value, investors can compare this value to the current market price to determine whether a stock is undervalued or overvalued. If the intrinsic value is higher than the market price, this suggests the stock is undervalued. In layman's terms, it's like finding a high-quality product on sale. The stock's price is expected to climb in the long run to match its intrinsic value, signaling a good buying opportunity. Conversely, if the intrinsic value is below the market price, it implies the stock is overpriced. This means it could decline in the future, so investing might not be the best move. But before we dive into detail regarding calculating the intrinsic value, let's quickly cover some basic concepts first. Money has a fascinating relationship with time. The time value of money is built on a simple truth: a dollar today is worth more than that same dollar tomorrow. This isn't just about inflation but about opportunities. Today's dollar can be invested to earn more money. The process of determining what future cash is worth today is referred to as finding its present value. The formula for present value is as follows: present value equals the future value divided by 1 plus r to the power of n, where r is the interest/discount rate and n is the number of periods in the future. As an example, assuming a discount rate of 10%, $1 received today has a present value of $1 divided by 1 plus 10% to the power of 0, which is equal to $1. Meanwhile, with the same annual discount rate, $1 received 2 years from today has a present value of $1 divided by 1 plus 10% to the power of 2, which is equal to 83 cents. Net present value refers to the present value of cash inflows minus the present value of cash outflows. So, what exactly is a discount rate? Think of it as the risk thermometer for your investment. The higher the temperature, the riskier the investment. Essentially, the discount rate reflects how safe or risky an investment is perceived to be. Therefore, the higher the discount rate, the lower the present value due to the greater perceived risks. In the DCF model, this discounting often employs the company's weighted average cost of capital, or WACC. The formula for WACC is as follows: WACC equals E divided by V times RE plus D divided by V times RD times 1 minus the company's tax rate, where E is the value of the company's equity, D is the value of the company's debt, V is simply just E plus D, RE is the company's cost of equity, and RD is the company's cost of debt. The cost of debt is usually just the interest rate on the company's debt. But to determine the cost of equity, the most common method is the capital asset pricing model, or CAPM. Per CAPM, the formula for cost of equity is as follows: RE equals RF plus B times RM minus RF, where RF is the risk-free rate, which is the rate of return from a risk-free investment. B is beta, which is a measure of how volatile a stock is compared to the market at large. A beta above 1 indicates the stock moves more intensely in the same direction as the market and exhibits greater volatility. A beta between 0 and 1 indicates the stock moves in the same direction as the market but with less intensity and volatility. A beta between -1 and 0 indicates the stock moves in the opposite direction of the market with less intensity and volatility. A beta less than -1 indicates the stock moves more intensely in the opposite direction of the market and exhibits greater volatility. A beta of 1 indicates the stock moves in tandem with the market, mirroring its volatility. A beta of 0 indicates the stock's movement is independent of the market's movement. And RM, expected market return, which is the average stock market return. Now that we've sailed through the concept of discounting future money to its present value, a pressing question arises: what exactly are we supposed to discount to determine a stock's intrinsic value? The answer lies in a term you'll often hear in investment circles: free cash flow. Free cash flow is the money a company has left after it covers all its costs and necessary spending. It's the cash that can be used for things like rewarding its investors, reinvesting to grow the business, or setting aside for future needs. FCF is used to calculate the intrinsic value because it's the actual cash that can either be given back to investors or put back into the business. One of the first steps of constructing a DCF model is to forecast future free cash flows. To estimate a company's future FCFs, analysts usually study its past performance. Though history doesn't dictate the future, it provides a helpful baseline. Analysts also consider the company's strategies, industry trends, and economic factors. However, forecasting too far ahead, like decades, is too difficult. So, analysts typically focus on predicting the next 5 to 10 years, with 5 years being the most common forecasting period, balancing between foreseeable growth and making informed estimates. Now, because the future is a mix of certainties and wild cards, DCF models often sketch out 3 versions of the future: optimistic, neutral, pessimistic. This way, investors get a spectrum of what could happen, from best to worst. After projecting the company's free cash flow into the future, the DCF model discounts it back to the present value using the WACC. By doing so, we arrive at a present value of the future cash flows. After forecasting a company's free cash flows for a certain period, there's still the challenge of figuring out how much the company might be worth beyond that time frame. This is where the terminal value comes in. Think of the terminal value like this: imagine you've been earning money from an investment for several years. When you decide to sell it, the amount someone would pay, thinking it'll keep making money forever, is similar to this terminal value. In simpler words, terminal value is like the remaining value or the lasting worth of a company, assuming it keeps earning money indefinitely. It tries to give a single number today for all that endless future potential. Because it's difficult to predict exact earnings forever, we use certain formulas to estimate it. One popular formula is the Gordon growth model. Terminal value equals FCF of the last projected year times 1 plus G divided by WACC minus G. G represents the perpetual growth rate, an assumed rate at which the company's earnings might grow indefinitely. A common way to estimate this is by using the historical average annual GDP growth rate. The basic idea is that, in the very long run, a company shouldn't be able to grow faster than the entire economy. The enterprise value calculates the intrinsic worth of an entire business by summing the net present value of free cash flows with the present value of the terminal value. It combines values for equity and debt holders. To discern the intrinsic value relevant for investors, subtract net debt from the enterprise value to get the equity value. You might wonder why we don't stop at enterprise value. Consider this analogy: buying a $500,000 house with a $100,000 down payment and borrowing $400,000. The home's $500,000 value represents the enterprise value, whereas your $100,000 equity is the equity value. The enterprise value includes both your equity and the lender's debt contribution. You won't be responsible for all its debts, nor would you own all its cash and assets outright. Therefore, equity value gives a clearer picture of what's available to the shareholders. Net debt is found by subtracting cash and cash equivalents from total debt. Why is cash subtracted from total debt? So, when we want to understand how indebted a company truly is, we consider not just the raw amount of debt but also how much readily available cash the company has to offset this debt. Therefore, to convert enterprise value to equity value, first take the company's total debt and subtract it by its total cash to get net debt, and subtract the net debt from the enterprise value. Finally, the equity value reflects the intrinsic market cap, which is the product of share price and the number of shares. For a straightforward assessment, divide the equity value by shares outstanding, resulting in the intrinsic value per share. Compare this with the stock's market price to gauge whether the stock is undervalued. Let me now demonstrate how you can use DCF analysis to quickly determine whether a stock like Walmart is a good investment. However, as demonstrated by the notable difference between the intrinsic value using the historic average annual percentage change in FCF and the intrinsic value using Excel's forecast sheet, DCF models can be highly sensitive to assumptions and inputs, leading to significant variability in valuations. While they're best suited for stable, cash-generating companies with predictable growth patterns, they can be less reliable for startups or firms in volatile industries where future cash flows are unpredictable. Thanks for watching. Please like and subscribe.